Hello, everyone, and welcome to Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I co-head G10 FX strategy here at NatWest. I'll be your host today, and it's almost hard to believe, but we're in the second half of 2026 already. It's been a really interesting first half, to say the least, and there's so much going on in markets. You know, as has become the norm here in G10 FX markets. The scale and magnitude of global issues doesn't seem to be translating as much into moves in major FX markets, but still important to discuss all of this as we look ahead to the second half. And to do that, I'm happy to be joined once again by the co-head of G10 FX strategy sitting over in London. That is Paul Robson. Paul, thank you so much for joining.
Thanks very much as ever for the invite. Very much looking forward to discussing those themes and market moves that don't seem to be influencing a lot of G10 FX currencies, but there definitely pockets of things that are super interesting. And as I say, looking forward to discussing those with you today.
Yeah, one of those pockets, I think one of these sort of, let's call it a minor theme within the scale of big global themes, is something that we've talked about on this podcast almost weekly for the past 6 months, which is that sterling resilience. Once again, I mean, we look at euro sterling testing the lows here, sort of breaking the range and testing the lows for the year. What are some of the drivers of that resilience, and how are you thinking about sterling here as we see it outperforming versus the euro?
As you rightly said, it does feel one of the key stories of the summer, sterling resilience, because I think a lot of people in the markets have quite a bearish view of the currency, and the fact that it's been so resilient, I think, is important. And certainly it's the currency pair we get, not just euro sterling, but also sterling dollar, or just sterling against a basket of currencies. It's one of the key questions that we continue to get asked by clients. So I think it's right that we start there. And like you say, euro sterling at its lowest level, not only this year, but for a year, and continues to make multi-month lows, which I think is super interesting. So I think there's a number of areas that we can concentrate on, usual suspects. I mean, one of the areas that I've concentrated on for the last couple of months is this idea that the UK continues to get maybe sort of safe haven flows from the Middle East. I've in the past made the comment that the UK has very strong links with the Middle East over decades, 50, 60, 70 years. And I think this is a strong established relationship between the Middle East and the UK. And it may well be that capital is just trying to find a home given tensions in the Middle East, and maybe people just feel a little bit less comfortable holding dollars in that environment. And I think the UK's probably and sterling has benefited from that. And just last week, actually just yesterday, when we had news about uncertainty about the longevity of the peace deal in the Middle East, or the ceasefire at least, and you actually saw sterling outperforming. I think that is noteworthy, and people should make note of that. There's a little bit of yield support here. Summer markets following currencies that have the highest yield. To be honest, the relationship between sterling and interest rate expectations hasn't been that great, but at the margin, this idea that the Bank of England has to raise rates because of worries about inflation expectations, I think helps. The starting level of yields was relatively high anyway, and if people like the idea of clipping carry over the summer, then that would help. We've obviously got a few moving parts around fiscal policy and politics here in the UK, but I think because it's not caused the initial volatility that people had expected, I think they see this as maybe a story for later on in the year and heading into the school holidays, given it's so still unclear what will happen in terms of fiscal policy under potentially new leadership. I think that hasn't had the impact that some people expected. And I think markets have been soothed by comments about maintaining the fiscal rules and the likely makeup of the leadership team. I think that they've taken that on board and can revisit it later. And there have been stories in the press here in the UK about potential M&A activity and buyouts and things like that. It doesn't take much to move the needle in summer thin markets, so that might be helpful. One of the areas that I was looking at this week is potential for equity inflow into the UK. So one of the indicators that I track is inflows into an unhedged equity UK ETF. And it's really interesting that that's picked up quite significantly over the last couple of months. So someone is buying into the maybe low valuations, maybe weak growth is low as it gets, excess pessimism, and I think that's important. So I think a mix of that, but I think it's the politics and fiscal policy as we go into the latter half of the year. I think that might be where some of the risk might grow for the currency.
Yeah, and that's exactly where I want to go next, Paul, because I feel like, in these conversations, those are mostly targeted in your direction, but certainly, when I am asked about the sterling, how infrequent that is. The big question that always comes back to is the politics and these political events. And, we have seen certainly periods in the past where sterling has been quite sensitive to changing expectations around budgets and also to long-term yields. We have 10-year gilts up maybe 30 basis points or so, really since the middle of June. That's a meaningful move, almost back to 5% in 10-year gilts. How are you thinking about political events in the UK and in Europe in general, and how that's feeding into your view here?
Yeah, you make a good point about the performance of the gilt market, bonds lower, higher yields. But I think on that particular driver of sterling, it's important that the cross-market performance of gilts hasn't been that bad, and certainly when we've seen spillover into the currency, you've also seen a significant underperformance of gilts cross-market. So how gilts trade against treasuries and bonds and things like that, and that hasn't been the case. And also, volatility in the bond market hasn't been as acute as it has been in previous episodes. So I think while I don't think higher long end bond yields in the UK is a sufficient condition to expect the currency to weaken. But it's certainly, as you say, one area we must be watched through the end of the year. For me, I'm just looking at some of the risk events now through the next sort of 6 months, and just a couple of dates. So today we had the nominations open for leadership of the ruling Labour Party here in the UK. Candidates can get their applications in by July the 16th. But if there is only one candidate to take over from Keir Starmer, then there'll be a special conference on the 17th of the month. So by the time we get to just sort of halfway, 2/3 through the month of July, we'll have a little bit of new information. And then from then it's about the policy agenda under new leadership, and quite quickly after that, I guess the focus might shift to who the new chancellor, if we are to get a new chancellor, will be. That'll be something that markets might focus on. But really, I think it's after the summer, the sort of latter part of the summer, into the party conference season in September, October, but then also the potential for a budget late October, November, which might come a little bit earlier than it has done in previous years. Because remember last year, everyone started talking about policy shifts so far in advance, and I think it sort of hit confidence, consumer confidence, business confidence, and they might just want to get that sorted. And then within that, I think for sterling, it's going to be about the fiscal rules, to what the extent to which they're maintained. Maybe any new leadership might think that they're a little bit too rigid. Do they need to be loosened? Does it need to be over a longer time frame? But at the end of the day, It's going to be about how much borrowing, the supply of gilts into the market, and who are the buyers and at what price. And the thing that the bond market has done, as you quite rightly mentioned at the beginning of the question, is that they do draw red lines and they do react. So that would definitely be what I'm watching.
Yeah, I feel like I'll borrow something you said in an internal call that we had, Paul, which was these markets don't feel like they can grab on to any one theme for all that long. And it certainly feels to me that, trading sterling off of potential changes in the budget all the way in the autumn feels very difficult to do when sterling still enjoys relatively high front end yields and you pay carry to hold those positions. I feel like maybe that's part of the story here. I do want to turn to Europe because part of this sterling relative strength does feel like it's a bit on the euro side, euro underperformance. I do want to ask you a little bit about French politics here because we just learned that Marine Le Pen plans to stand in next year's presidential election in France. How are you thinking about the potential impact on the euro here and how this might be feeding into valuations?
Yeah, it's interesting how you described the focus for the UK in terms of budget, and markets can be quite short-sighted at times. As you say, just repeating what they sort of said at that internal call. And it is very much the same with the euro and French politics. The presidential election is 2027. I know that that we're not having this podcast all the way back in 2025, and it is going to come in view, and it may well be a focus for our year ahead. But we'll be publishing in March, middle of November as usual. And in fact, markets took the announcement that Le Pen will challenge for the presidency next year relatively well. OATs, French government debt, have actually been underperforming bonds, and I think that is important. But I don't think markets are really going to latch on to politics right here, right now, and it will be later on in the year that it becomes more important. But it is an area to watch because one of the key drivers in our models for euro dollar is that spread between a mix of French government debt, Italian debt market performance versus Germany. And I think this captures quite nicely growth risks and political risks and sort of tensions within the EU. And as that spread widens out, the euro can weaken. And maybe that is part of that euro sterling story or question that you asked at the beginning. And actually, when I look at euro dollar, I find it remarkable that our model of euro dollar has remained so stable in recent years. We don't really have to do a lot of maintenance. And we find that euro dollar is a mix of short end rate expectations, so 2-year swap rates, the slope of the European bond curve relative to the US, and that EGB spread, that European government bond spread. And the recent weakness in euro dollar has been captured by that. And it does show you, for now at least, that euro dollar is essentially a relative monetary policy play with a little bit of political risk. And there's very little in that on the dollar side to suggest that we're seeing capital moves, because if there was a breakdown between fair value and spot, then that might indicate that there are other flows that aren't captured by relative rates. So I think that is an important area. But at the moment, I don't think French government worries and political worries are going to start to undermine the euro. I mean, as you say, in terms of G10 FX, markets have been really quite subdued, haven't they? There wasn't a huge amount of sensitivity to news out of the Middle East, US, Iran this week. And I was just wondering how you were thinking about that interaction in currency markets.
Yeah, I think the first one is that for the last several months, really since the initial ceasefire, I think markets have been trading the Iran headlines, the back and forth, with a somewhat optimistic read to it that any small escalations would not lead to a resumption of major conflict, that the direction of travel multi-month is probably towards better energy supply conditions rather than worse. And I think that's the condition that's still prevailing now. I mean, if you look at oil markets as they stand today, Brent front future up from the low 70s into the high 70s in dollar terms. That compares to the height of the initial war, where we went from around the low 70s all the way up above $100 a barrel and higher. That's not to say that oil markets can't continue to move up if these moves continue, if this escalation really does continue. But I think it in part reflects the market having a bit of the forward-looking view still being that the worst of the crisis is behind us. And I think that's reflected in oil markets. A second one is that dollar positioning has changed dramatically since the start of the war, right? That going into the conflict, the market, I think, was broadly short of dollars. I think there was a really compelling case for further dollar weakness, whether that be because of low volatility, good environment for risk assets. I think there was a very good argument that had the Iran war not started, that the Federal Reserve could be considering easing or may have already eased at this point. Obviously, a lot has changed over that time. And one big one is that dollar positioning has flipped from very short to very long. So CFTC positioning as an example, the futures positioning from CFTC, it's not representative of the whole market by any means, but I think it does give you a good sense of when positioning is changing sharply. And what we've seen in our estimate of dollar positioning, when you look at all contracts and say, okay, if people are short euros, that means they're implicitly long dollars. When you sort of add that up, you find that positioning at the eve of the Iran war starting, dollar was at its lowest, as in net short of dollars was at its most extreme since 2021. Now net longs of dollars are at their highest, encroaching on their highest level since 2015 and their highest level since 2019. So what that implies is that the market is now so much more long of dollars, and that that maybe there's a little bit less juice in terms of pushing the dollar stronger. That needs to happen as the market sees this level of escalation. Now, I think there are good reasons why dollar positioning has shifted so much. We could talk about some of the more cyclical local drivers in a second, but I think as I think about FX markets and the escalation, number one, I'm watching energy prices, and so far the scale of this move is smaller. I think that reflects long-held view in the market that the worst of the crisis is still avoided. President Trump still seems to be trying to lean into any escalation being potentially short-term. I think a continuation of talks is probably still going to be the market's base case for now. And the second one being positioning, that the market in March and April corrected very sharply from very short of dollars. Now the market is already very long of dollars, and maybe there's less of that corrective style move to happen even when these conditions change.
Yeah, that's all very clear. So I just wanted to delve a little bit more deeply into what we should expect from the dollar as we move deeper into the second half of the year.
Yeah, so as we move away from Iran, I think there's two competing narratives that are sort of running parallel to each other for the dollar. The first is this external picture from Iran and from the war. And the second is the internal picture, the cyclical one. So on the external side, as mentioned, there was a big correction in the dollar. The dollar strengthened quite a bit. There were times when it was sort of moving lower. And my assumption has been that energy prices where they are currently, albeit without the most recent escalation, probably lends itself to a weaker dollar. That as the markets price away the worst of the crisis, they price away the worst of the negative impact on non-dollar economies, on oil importers, and at the same time price maybe a better outlook for risk and global growth, then that's something that probably leans against the dollar. But we really haven't gotten any pullback in the dollar, and that's because in parallel to this sort of normalization of energy prices, we've had the U.S. economy, the cyclical economy, showing quite a bit of resilience. And in fact, for really the better part of the last 2.5 months, most, if not almost all of the economic data in the U.S. have surprised to the top side. That includes a couple of really hefty non-farm payroll prints, A couple of frustratingly strong, particularly headline inflation prints. Some of the survey data have improved. Job openings have improved as well, maybe giving you a sense that labor demand has stabilized here, and the unemployment rate remains low. And so I think part of this move higher in the dollar, pushing towards the range highs or at the range highs at points, and years highs, I should say, is that the cyclical picture has certainly improved. And so one feature of the dollar move we've seen in the last few months is that you mentioned, Paul, when we were talking about euro dollar, how short-term interest rate differentials tend to be a pretty important driver. It's similar for the broad dollar. In the first 2 months after the US-Iran war started, the dollar rally was happening without interest rate differentials moving in its favor, i.e., US front-end interest rates were not moving up relative to their peers. That, to me, was a notable sign that the dollar rally might have been running out of steam had the cyclical economy not helped boost that move. More recently, what we've seen is U.S. interest rates have moved up and sort of led that move because the cyclical data have improved. And so the dollar rally that we've had feels like it's on more stable footing. And so I think these are the two factors that we're trying to balance here as we think about the outlook. Still think that the second half outlook for the dollar, I should mention at the start, we ourselves revised up our profile for the dollar for the second half of the year. We still expect it to weaken over the course of the latter half of the year against global currencies. Talk about that in a second, but we think the scale of that weakness is probably less now, just reflecting this stronger outlook. One factor is that we no longer see the Fed cutting interest rates this year as a base case. The fact that the resiliency in particular of the labor market, and clearly the message coming from, call it the rank and file, the regional presidents, clearly there's a number of individuals on the Fed who see the next move as a rate hike, means it's probably going to take quite a bit to push the Fed back in the direction of easing. But equally, we don't have a rate hike this year in our baseline, in part because we think upcoming measures of core inflation are probably going to start to look a lot more well-behaved. Over the next couple of months, we think the core PCE deflator could continue on a downward trajectory. Think about something like a 3-month moving average of the core PCE deflator. We think in September that might come as low as 2.1%, which is, a hair, within striking distance of target. Now, that's not a, the target is not 3-month annualized, but it tells you that the trend might be moving back in the right direction. Also, optically, we should be getting some better numbers on inflation from headline, thanks to energy prices. And so we think that in combination with the labor market that, while not weak, is not particularly strong, certainly stabilizing, but stabilizing at, I would consider, still relatively low levels of job gain, low levels of job churn, low fire environment still staying. I think in combination with the positioning shift we've had in the dollar, the market is already very long. A lot of good news we think is in the dollar at this point. You take that in combination with our view that if core inflation starts to come lower, the Fed is probably not going to be forced to increase interest rates this year versus a market that is priced for a full interest rate hike this year. I think that still leans towards a weaker dollar as the baseline, but I should say, as I mentioned, that we upgraded our expectations in terms of how far that move could go in most cases, just reflecting the fact that the outlook has clearly gotten better on the cyclical side, and the case for rate cuts in 2026 has kind of fallen away here.
Yeah, that all sounds very sensible. Like you say, maybe just a slower, later decline in the dollar, and certainly over recent months, the way you've described this balance between the cyclical position of the US economy and the dollar versus sort of potential structural headwinds. I still think that's a nice way of putting it. And when you talk about that cyclical position, it was very interesting to hear what you were saying about stretch positioning either side of the Iran-US conflict, and how much good news potentially is already in the dollar, weaker dollar through the second half of the year. We've obviously got the midterms. I'm sure you'll be all over that later once we get back from our summer holidays, each of us. It's interesting, isn't it? The dollar has been resilient. One area that it does shine out the most is dollar yen continuing to move higher. And it certainly is interesting that there doesn't seem to have been any confirmed intervention from Japan's Ministry of Finance to lean against any persistent yen weakness. I was just wondering, is that a surprise to you, and just any broader thoughts about dollar yen and its importance for global currency markets?
Yeah, I think it is a surprise that the MOF has not stepped in. Just for context, dollar yen has now, in recent weeks, has tested and broken multi-decade highs. They've shown sensitivity around the specific 160 level. The previous high before intervention a few years ago was just below 162, the figure. And so this is a level where the market has clearly been sensitive. We know that the MOF stepped in late April, early May, so we do have intervention fresh in our minds as a driver. And the MOF has suggested urgency, and their approach to intervention has clearly suggested that they might be targeting illiquid periods to step in and push the market and maybe try and punish speculators who we think are still reading, that might be reading broadly short of yen still. We've now come and gone from a couple of, this is the summer markets, right? Relative to other parts of the year, you can argue that every day is somewhat illiquid in summer markets. But we are coming out of the July 4th holiday here in the United States and the Juneteenth holiday. And I think there were some market expectations that those might provide opportunities for MOF to step in during illiquid periods to try and push the currency stronger against the dollar. So it has been surprising, and I think every day that goes by is a new data point that helps us inform on the reaction function of the Ministry of Finance. And every day that they don't step in maybe gives the market just a touch more confidence that there's tolerance of a weaker yen. And I think there's some appropriateness there. One of the things that the MOF has signaled is that currency weakness that's outside of lines with fundamentals and is fueled by speculators is something that they want to stand against. They want to counteract. I think it's a bit harder now to argue that the move in dollar yen, say off of where it was in early May from when the last intervention took place, is strictly out of line with fundamentals, because over that time, as we just discussed, the dollar is broadly stronger against major currencies. So this move is not happening independently. It's not happening in a vacuum. It's not purely a yen move. So I think it'll be harder for MOF officials to go to their U.S. counterparts, say Treasury Secretary Bessent, and argue that yen weakness at this point is fundamentally unjustified when the dollar is stronger against a lot of major currencies, including the yen. Another factor is the almost futility of intervention. When you consider the scale of interventions, the Bank of Japan MOF has significant currency reserves. They have plenty of reserves to continue interventions. But at some point, you have to wonder if using that capital to intervene when it's only allowing for a couple of weeks of reprieve in the currency, is that good bang for your buck? It just so happens that we are in a period where Japan is also considering, significant new fiscal stimulus, and they're trying to engage that fiscal stimulus without issuing new debt, without adding to the pool of JGBs. And they need to get creative in finding ways to finance that. And one of the possible financing options that's been floated around is, do you change the way that currency reserves are managed? This pool of assets is over $1 trillion, and the government does get remittances from that, and come back to, say, if it's invested in treasuries, the gains on those, the yield from those finds its way back to the government. But if the government is considering being more creative, more flexible, using these funds, differently within the government, it might not be worth employing them for just a couple weeks of yen reprieve. So that's certainly something we're watching. One of the things we've discussed quite a bit on this call is fiscal policy. I mentioned it a second ago, but it's worth flagging again. GGB yield 10-year point is at its highest point. Now, I think the market is right to be skeptical that Takaichi and her government can accomplish everything she is hoping to accomplish on the stimulus side while avoiding issuing additional JGBs. The fiscal picture is one that, certain economies feel like they get really punished for the concerns around fiscal largesse, and others, feel like they kind of get away with some fiscal largesse. Japan is certainly in the former camp at this stage, where yen weakness is in part reflecting markets' concern over fiscal policy and monetary policies, maybe unwillingness or inability to respond to that. So we still have Bank of Japan policy. I should mention the Bank of Japan did hike the policy rate in June. Their interest rate, did move up to 1%. But at 1%, their yields are still very low, both in absolute terms and in relative terms. In real terms, relative to inflation, yields are still deeply negative. And that carry disadvantage is still a massive headwind for the currency, even as it's normalized because of BOJ interest rate hikes. And so I think the market's assumption is that the BOJ may be either hamstrung or unwilling to make a big hawkish pivot at a moment when the Takaichi government was elected with a mandate to push fiscal stimulus, to lower consumption taxes, and, with a sort of populist agenda, the Abenomics 2.0. One of the features of Abenomics 1.0 was full monetary stimulus and full fiscal stimulus, that fiscal monetary mix being very negative and purposefully being very negative for the currency, right? Abenomics comes around at a time when dollar yen is closer to 75.80. Now we have a secondary version of that with dollar yen closer to 160 and inflation so much higher. And I think the markets are seeing a fiscal monetary mix that's still quite accommodative against the backdrop of other economies where interest rate hikes in some cases have resumed. And I think has seen the yen weakness there, I think is therefore justified. So we've covered a lot of ground today, Paul. Thanks very much for joining. I think this was a really good conversation to kind of set the stage for what should be an eventful second half of 2026. And to our listeners, thank you so much for joining. If you enjoyed today's podcast, please consider giving it a like and also subscribing so you can get our latest issue the moment it's released. Thanks very much.